Welcome you all for the panel discussion on a very pertinent topic, and that is changing landscape of SME financing. Without further ado, it's time to invite our session moderator, Mr. Prakash Jaiswal, Country Head, Business Banking, MSME Startups, HSBC India. Thank you so much, sir, and welcome.
Thanks, Pooja, and a big warm welcome to all the audience, our esteemed guest. And I'll start by, Pooja has already done my introductions. I'll start with the introduction of our guest. So we have Vasant. Vasant is the founder and CEO of a company called ofbusiness. Ofbusiness. So firstly, congratulations, Vasant. It's a recent unicorn, so big congratulations for that.
Thank you.
Ofbusiness is one of the largest B2B platform, and it's trying to solve the whole credit and commerce credit part, and we will hear all the details from Vasant. I also have Anil. Anil heads a agri-tech platform, a very interesting business model called Samunnati. I'm actually not going to speak more about Samunnati because I want Anil to do that. He's been a career banker, so look forward to hearing. He also set up the IFMR rural channel and services enterprise, which is itself is a pioneer kind of initiative. So thank you, Anil, for coming in. And we have a very interesting gentleman called Rishikesh Mehta. We will call him Rushi. He's co-founder and chief evangelist of a company called CredAll. The name says it all. It's credit for all. And his company is trying to solve the whole problem of making credit available democratically to everyone. And he's working on the very interesting concept called Locain, and we will hear in detail. But before I go to my guest, I wanted to set the context. So if you look at the MSME landscape in India, it's a very large contributor or a very large part of the Indian economy, right? I mean, whatever data point you take, exports, employment, manufacturing units, GDP percentage, it's a very large contributor. It's also a very large set in India. It's like more than 6 crore MSMEs in the country. But again, if you go to the financing part, it's very disproportionate, right? The size and the contribution the MSMEs place to the economy is not very proportionate to how financiers treat it, if I can use that, if I can take the terminology. And there are various data points which kind of depicts that there's a huge credit inclusion problem statement we have to solve. Banks or other financiers, the traditional ones, and I represent one of them, we have always solved the credit problem over decades and years by different conventional method. And it's very clear that we have to go to alternate methods using data, technology tools, alternate data, platforms, partnerships. All that approach has to be taken to solve this problem, right? When I was thinking about putting this session together, a huge problem of how many people do we invite? Because it's a very vast area, there are various pieces of work happening, and I think we would need multiple sessions to cover all of them. So I took the call of inviting 3 subject matter experts who needs to be heard in for that area of work, and we deep dive into those 3. So with that, I will put my first question to you, Vasant, Anil, and Rishi, and I'll put the same question to everybody, where you do talk about the problem you're trying to solve, right? How are you solving the problem of the credit gap and the financial inclusion? So I know, Vasant, you're on the road, so we will give you the preference. Vasant, why don't we start with you?
Thank you so much, Prakash, and it's a privilege to be a part of this. When you talk about what problem we are trying to solve, it's very interesting that, a lot of people try to get the ambit of new to credit into the, financial ecosystem. But even if you look at those who are well banked, you will realize that they are underbanked. And that's fundamentally the credit problem that, we solve. Today, if you look at the value addition economy of India, that is, if you look at, say, manufacturing or contracting, and this typically constitutes, you would say, around 30% of India's GDP, you will realize that yes, a lot of them are banked, but a large part of their working capital requirement is today driven by an informal network of dealers, distributors, vendors, suppliers, manufacturers, and a lot of them drive on operational credit, which comes in the form of credit for materials that they consume as a part of their process. Commerce, which typically would constitute 70% of their entire cost base, today is a credit for that is enabled by an informal network of traders, dealers, brokers, manufacturers. And not only do they get access to the needed capital, the flexibility in repayment, or that linked to their cash flow, but the cost of this credit is exorbitant because it sort of gets layered into commerce once there is no transparency, and two, indirectly goes at 24 to 36% per annum. So what we do at Off Business is that we don't look at the standard collateral asset-backed lending that banks would have already funded to these guys, but we actually look at transaction-backed lending. We look at how their operational data for procurement, for the materials that they procure are, and based on that, we give them credit facilities. We also have a commerce platform where we give them price benefit through our aggregation and disintermediation. But even standalone, the credit lines that we provide to them come up to be a very cost-effective option to the conventional dealer trade or the informal finance that's a part of their ecosystem, which typically constitutes 30 to 60% of their entire working capital requirement. And it's really interesting that this is not only a requirement for a small MSME or a SME, but even today a mid-corporate or a large corporate like ITC, and that's where I came from before starting Off Business, take a lot of credit from their traders, dealers, vendors for all their projects. And there's a huge exorbitant cost that gets layered onto it. So we break that, give them price saving, and give them cash flow backed financing for the commerce part of their business.
Perfect, Vasant. So you come in the category of cash flow financing, if I can say that, right? So let me move on to Anil. Anil, you run a very interesting platform. You're trying to solve the whole problem of finance being available to farmers, the small landholders. Why don't you talk about your venture, Anil, and what problem you're trying to solve?
Thank you, Prakash. Am I audible, visible? My bandwidth seems to be acting up a little bit.
No, right. Anil, you are perfectly fine.
Thank you. So, Samunnati, the name means collective growth, collective prosperity, and collective elevation. And the reason why we as an organization exist is to make markets work for smallholder farmers. There are two ways in which the pursuit of making markets work for smallholder farmers can be looked at. One is starting from the bottom of the pyramid where the farmer is and moving upwards, or looking at where does the market start looking at making the farmer meaningful and then working backwards, right? If I can take the analogy of Maslow's hierarchy of needs, we all know the five, right? The psychological, safety, then needs of belonging, then egocentric self-actualization. If I can put the same for the farmer, the agriculture, agriculturist and agriculture labor, access to finance is the first of the problems. Forget about customized finance. That's the second of the requirement. That's a higher order need or higher order aspiration. Then the third is market linkages. Together with finance, customized, and can I get market linkages? And then advisory services. How do I produce what, say, Vasant can take me to market? How can I produce to reach the markets? And the self-actualization phase is where there is also a layer of protection, where there is a layer of guarantee, where should any of these four fail, access to finance or market linkages or the new practice that I have put together has not worked, is there a safety net for me? So for an entity to make markets work for smallholder farmers from the self-actualization dimension in this example, we need to play the role of an aggregator. We need to play a role of an integrator where you work with a set of players in each of these, players in the agri-finance space, players in the agri-commerce space, players in the advisory services, bring guarantee structures and insurance, right? Samunnati is aiming to do all of this, where we are an ecosystem player to look at bringing in a lot of good work that is already happening in the ecosystem, and also bring in those areas where it needs more attention, it needs more working together. We started our journey with financing. Then we realized that finance is only one part of it. You have to bring in market linkages. Now we have slowly started moving towards the guarantee structures as well as the advisory services. So that's what we are doing. How do we make markets work for smallholder farmers without touching them first? By working with the ecosystem, working on the demand side, working on the productivity side, working on the market linkages side, and eventually take all the benefits to them. So the moat for us is FPOs and smallholder farmers. Prakash.
Perfect. No, I think we would need to deep dive, but let me go to Rushi. Rushi, you're doing a very interesting, the whole Ocane framework. And I always, when I was chatting with you, we use the word UPI of lending, or at the speed, at the speed of light. Why don't you talk about? And I'm sure the audience would love to hear and learn from what you mentioned to us.
So good afternoon, everyone. Thanks for having me here. Our singular goal is to be able to give credit to as many people as possible, right? And the size of the loan should not matter. So, in like a single sentence, we'd want to sachetize loans just like maybe Hindustan Lever did for shampoos, right? Like you don't sell it in bulk, you sell it in 1 or 2 rupee sachets. Now, in this context, we actually created a protagonist who we are trying to solve for over the next 15 or 20 years, and that protagonist is Rajni, who is basically a vegetable vendor sitting in a small village in India, and she has access to the internet and a smartphone. And the idea should be that she should be able to take a 500 rupee loan at 9 in the morning and pay it back by 5 p.m. in the evening, where she takes a loan, buys vegetables, sells them in the market, and then pay back the loan in the evening. Without it being cost prohibitive for a lender to do that. So today, cost of acquisition for lenders is very high because there's feet on street, there's KYC, document collection, manual assessment. So the leapfrog we are trying to create, sort of what credit bureaus did for retail lending almost 15 years ago, is try to create a high provenance set of data which can be used to underwrite to these people. And the second piece is there's also a lot of customization. When aggregators or like even e-commerce sites are linking up with lenders, there are different ways to integrate different processes. So what we are doing with the Open framework, which is the Open Credit Enablement Network, is to create a set of standardized APIs that these guys can use to talk to each other. So what we're hoping to achieve is like when we have, about 40, 50 lenders set up on one side, what we call a loan service provider on the other, and that loan service provider could be a e-commerce site, could be maybe someone like ofbusiness when they want to do smaller ticket sizes in the future. It could be a Google Pay, it could be anyone that has millions of users. And they could just plug in and then suddenly have access to product from 50 banks immediately without having to integrate with each one first. So what we are hoping to do is create a Cambrian explosion of different credit products, and the ticket size should not matter. So we've started with with the government e-marketplace in a product called Gem Sahai, where small vendors and sellers on Gem Sahai can get instant purchase order financing once they've accepted it. So, a case in point is that we've been able to give a 238 rupee and 40 paise loan and disbursed it in less than 10 minutes from the start of the journey on the app. So it's just the beginning, right? So that is the first reference implementation. We're going to do the same with invoice financing on GST, on the GST platform, and then eventually open it up to a private marketplace participation on the loan service provider, which is the guys who have all the users sitting on their platforms eventually. And we're hoping that a lot of LSPs, and they have already come forward with different use cases, whether it's kirana stores, pharma distributors, steel and green energy suppliers, who all want to provide this service on their platforms for their traders and vendors and so on. So that's the general idea. So while people usually solve the bigger ticket size, and like while everyone's doing a great job on that, we've gone the next step is to solve for the marginalized who are not getting any credit today, and to do that based on informational collateral, not physical collateral.
Perfect. No, thanks, Rishi. I think what you were trying to solve is the bottom of the pyramid, right? At a very democratic cost of acquisition and servicing as well.
Right. So, to Vasant's point, like, a lot of these guys pay 24, 36% even today after being new to credit. And, one of the big mindset shifts, like today, if you talk with a lender and you talk about credit policy, if they look at new to credit, they're put usually in the same bucket as a subprime borrower. right? And that just makes like it's stunning, right? Because okay, if you have credit bureau data, you're good. If you don't have credit bureau data, but you have good cash flows, you're subprime. So what we're trying to also create is a shift in mindset that if I have your GST data, which is a proxy for what turnover you did, if I have your cash flow data from what the bank statements that I have, then I can actually use that and create a credit score around that. It doesn't necessarily only have to be credit score data. So this information that has been created can be harnessed to unlock value for the user, where today it isn't.
Perfect. Great. Okay, this is very, very inspiring. Let me move to my next question, which is again a general question, and I would like all three of you guys to answer. So when you're building these businesses of new age financing using data, digital, you're trying to create a new world. I'm sure you face challenges. What challenges are you facing, and what's your expectation from the legal, regulatory, or the government framework, the larger support framework? And let me go to Vasant again. Vasant, what would you say there? What are the challenges, and what's your expectation from the larger ecosystem?
Right. So I think it would come to the evolution or the early journey, right? So sometime in 2017, we actually wanted to partner. We did not want to become a full ourselves, and at that point in time, we wanted to sort of partner with existing banks who have enough balance sheet strength to actually partner with us and sort of lend out to them. And then I think we realized that typically most co-lending or any arrangement between a fintech and a banking financial services player typically layered on a large amount of guarantee from the loan originator. And at that point in time, it was more a realization for us that, hey, one, the underwriting or the way we are going to assess is based on a lot of proprietary data that we are collecting. We are also sort of acquiring the customer by having our own tech as well as our FOS network to sort of reach out there. But despite doing that, if the major part of both the yields out of this go to the ones with the balance sheet, that's your banks or your larger institutions, then if for us the economics of co-lending or originating with them did not make too much sense, because we realized that all the data sets, the acquisition, the tech, as well as the collection support and everything that is done even later was done by us. So I think at that point in time in 2017, while we did try to partner with different institutions, we realized that it would make a lot more sense to, become full stack. And then hence we got our own NBFC license. Today we realize that, hey, we do originate, we do take the risk anyway, so we may as well take the entire spread that's associated with giving that interest, and hence that's sort of an evolution from just being a fintech player to a full stack NBFC. Now no major regulatory requirement changes because of the type of the ecosystem that we operate, but then probably had we had the existing institutions more curious or more ready to look at different segments or different forms of credit evaluation, we would have probably not had the need to be where we are today. So that's one experience of how our partnership has evolved.
So your challenge is more from the old age, the banking financiers.
Banking.
Yeah? Okay, that's good to hear. Anil, what would you say around challenges and expectation from the system, if I can use that word? Anil, could you hear us?
Am I audible now?
Yes, you are, Anil.
Am I audible now?
Yes,
Okay.
Anil, you are.
So maybe I'll just go off video. Right. Okay.
Sure.
Is this better, Prakash? My apologies to all the audience. I don't know what the problem is with the network. I was on a Zoom call for about 2 hours now. It was picture
Anil,
perfect.
Anil,
I'm
this
able
is
to see
perfect.
Vasant and
Yeah.
Rishikesh.
No,
So
it's
I'll
perfect,
just
Anil,
go
on.
ahead.
Yeah.
Right. Okay. So we work with farmers collectivized as farmer producer organizations. That's the reason why we exist, as I mentioned in my previous remark. And the moment you look at farmer collectives, there are multiple things that would come in the context of this question, Prakash. One is, how do we collaborate with banks and other financial institutions that are interested in what are called the priority sector assets? And the banker remark that you made in your opening remarks, that banks are supposed to do priority sector as directed lending. But do they see the opportunity in the directed lending, or is it jabardasti lending? This is one dimension that one has to be cognizant of. The second dimension is the government schemes and many of the initiatives that the policymakers take with the sole objective of reaching out to the last mile and reaching out to the beneficiary. Now, in order to make these schemes more prolific and more ubiquitous, it is important that at a policy level, one has to expand the scope of the kinds of vehicles that they can look at, in addition to banks and financial institutions. More often than not, it is a standard practice that all the schemes that are so beautifully designed are made to go through banks and other apex organizations, which have been for decades used to deliver these services. So in the context of the current landscape, we do have many more entities in addition to banks and the apex organizations like NABARD, SIDBI, and other organizations. There are a host of institutions, could be fintech, could be agtech, could be new age entities, which all have the capability to provide the last mile, which is why the schemes exist, to reach out to the last mile beneficiary. And how can the policymakers include, not give a special dispensation, but expand the scope of which are all the entities that are eligible to make these schemes and guarantees available. And that kind of enabling environment would make the beneficiaries more reachable by entities that are using technology as as a tool. If I can use a Hindi saying, जिसके पास चना है दांत नहीं है, जिसको दांत है चना नहीं है. How can we make chana and dant come together? That the ones who have the reach and ability to reach out to the excluded population, can they be eligible for the institutional support that is available to make the schemes reach out to the intended beneficiaries? That's it. I pause here, Prakash. We have to expand the scope of which organizations should one collaborate. And of course, when OCEN comes in, Rushi may want to look at even NBFCs and fintech companies and other entities also on the same equal footing as scheduled commercial banks.
Absolutely. I think that leads me to Rushi. Rushi, what would you say? You will have a lot to say.
The first thing is, just on your comment, but it seems generally that NBFCs are actually more flexible. So our first partner actually to go live on Gem Sahay for the OCEN framework was Ugro, and NBFC, and there are others also very keen on participating because they tend to be a little more aggressive and flexible than the scheduled commercial banks we are working with as well. But it's not that we've excluded them. In fact, they're the ones who are more willing to participate. Okay, in terms of answering Prakash's question, right? So I guess I'll open with what is somewhat obvious, but laws tend to be static and created at a time solving a particular problem, and usually those problems were maybe 15, 20 years ago. But our environment is dynamic, so that creates some natural tension, right? And especially in the space we're in, where things are evolving so quickly, and we've done things like Aadhaar and UPI and account aggregator. So now we live in a world which is substantially different from a lot of the rules that were initially implemented maybe 10 or 12 years ago. So, I mean, my general request would be to have a look at those, especially with KYC. Simple illustration would be, there's an RBI regulation for a sole proprietor. If you want to give a loan, in addition to eKYC, you need 2 additionally digital signed documents, which could be Shop and Establishment Act or what have you, or GST. And some of these guys are not savvy enough to provide these. They might be able to do the Aadhaar, but they might not be able to do the others. So what we've effectively done is the people you are trying to serve, you've actually excluded them or crowded them out under the burden of paperwork. So to look at those things and to simplify with the technology we've ourselves built as public goods, and to use those to effectively open up the floodgates of credit, right? So another example I'd give you is with the account aggregator. Now you're getting high provenance data straight from the bank after a username password has been implemented. So there's something we call foundational KYC or derived KYC, which is if you get data through the account aggregator, and because the username and password has already been put in, why can't we disperse money to that account without needing KYC at all? Because you're just piggybacking of someone else's, right? So my general request would be to look at those and to streamline them and make them enabling for what we are trying to do, so that we can actually create use cases. It can be done in a controlled aggression, right? Where you do it in a controlled fashion with some caps, you see that it works, and then you expand it. So, for example, even the eKYC, where we do it with the OTP as a 60,000 rupee limit in 1 year, fine, let's expand that to 2 lakhs or 5 lakhs and then see how that works. And then after a year or two, if everything's fine, then expand that to 10 and then maybe remove the cap at some stage. But take a more aggressive experimentation approach to this, because otherwise to be able to help create data that gives proof that this works becomes very, very difficult. So, I mean, we're in the process of doing that. And to prove that it's possible, the fact that we can disburse a loan in 10 minutes from a start of an application journey is unheard of, right? For a sole proprietor or MSME. Now we've proved it's possible. So let's enable that and open the floodgate, so to speak, because credit will help pull us out of this post-COVID crisis that we're sort of in terms of liquidity, right? So that's my 2 bits. I mean, to be more dynamic and not static, which laws tend to be.
Perfect. No, I think your ask is very clear, Rishi, that you need the regulatory framework to be more dynamic, because you're trying to do something which is very, very dynamic by itself. Perfect. Let me move to my last set of questions, and then we will spend some time on the Q&A from the audience. So this question is, I'm not putting the same question to everybody. I'll put different questions. So let me start with Rishi. And you heard Vasant and Anil in a way setting their expectation from banks. But what is your expectation from banks, NBFCs, basically the whole financing world? What is your expectation?
So look, there's no question that there's interest in wanting to participate and wanting to lend. But there's an opportunity so if we have a 190 crore balance sheet, so to speak, of credit outstanding in the market, there's an equal unexplored market waiting to be exploited. But let me say addressed. Exploited is probably not the best best word. But my request would be when participating, one is to participate, to come and try, because everyone wants to go, right? If you're a profit-seeking company, growth is where it's at. Otherwise, you can just stagnate at the same place. But I think the singular ask would be so the first ask would be to participate, and the second one is to take a few risks and to be open to thinking differently than you have done so far, right? Because we tend to be path dependent. Institutions tend to set rules that I will lend to an MSME in a certain way. It has to have collateral, has to have turnover requirements. I will lend to retail in a certain fashion. What I'm asking is now, can you marry the two and come up with a third new product and address a whole new segment? So one is to so basically participate, be a little aggressive, and change your way of thinking to try something new, because doing the same thing will just get you the same result.
Perfect. So you're actually hinting that the bankers have to change their mindset as well and be a little more experimental. Perfect. No, that's very clear. Good. Let me go to Vasant now. And Vasant, I have 2 questions for your kind of business. One is, how does what role the tech plays in your business? And my second question is, which I'm sure is in the minds of everybody in the audience, that how did your lending business fare during COVID? So I have 2 questions for you, Vasant.
Sure. Thanks, Prakash. So I'll tell you 2 things that tech helps us and 1 thing that it doesn't, right? So the first thing, large part of our acquisition is tech driven. And I think that was one of the beginning point of, understanding how we could keep our costs and our OPEX very low, typically when you want to build a lending business. The other challenge for us was also that how do you ensure that you use tech for acquisition without resulting in a large change in behavior of your SME, because behavior change does not sort of happen overnight, and you should build your tech layered around what his current behavior is. So interestingly, I think a realization that came to us is that today, if you look at most SMEs in the value adding sectors like manufacturing and contracting, they do not go online to get loans, but they definitely have been going online for the last 10-15 years to reach out for tenders and access to growth opportunities. Now, this is a behavior that has been entrenched in them for the last 15 years, but the pain point there was that today they have to go to the website of every different institutions, say a BHEL, say a MORTH for roads, say something else for railways. And literally today, an SME was going on a daily basis and had an entire tender team to look at access for demand in across 20-30 different portals. We realized that let's first solve that pain point and give them an aggregated platform where they have customized access to tender and also intelligence to bid better. That became our acquisition engine. And if you'd notice, nowhere in this entire model is the word loan associated with it. We were able to harp on this existing behavior of an SME who's got used to going online to search for tenders, and that became our acquisition engine. The beauty of that is that that gave us such a large curated lead space that today, when someone bids for a railway tender, we call the customer and tell him that, hey, I know you're bidding for a railway tender. You would definitely need stainless steel here, and you would definitely need capital because, say, the ICF will pay you in 90 days. Why don't we provide those services also to you? So our tech first became an acquisition engine, but at the same time, we had to bring it out without causing a change in behavior. And I think that's a secret of the scale that we have gotten. The second thing that tech has sort of helped us, get into the picture is also linked to the answer of how we have battled through COVID. Is that we believe that lending has to be a high touch point service that you are doing with the customer. Today, if we are underwriting or assessing a customer just based on financials, just based on data which is probably a year old, your understanding of his current behavior is very limited. In fact, the reality is that when an
Sorry.
SME when an SME defaults to a financial institution, you can be guaranteed that he is probably the last person to be defaulted. The supply chain has already felt the pinch much earlier. So, because we are a part of the operational supply chain on a high touch point engagement with the customer for using our material platform, we understand on a live basis how the SME's cash flows are because their touch point with us is on a weekly, monthly, bi-monthly basis. That helps us have constant interaction with the customer, and at the same time answering your question of how did we handle COVID. Because of such a high touch point engagement that we had with SMEs, we were able to understand their requirements upfront. We were able to understand the challenges that they faced upfront, and also because we were giving them services beyond just lending, their intent to prioritize us for the other services that provided was also much higher. So we were able to leverage this high touch point tech to actually keep our portfolio in control. And including write-offs or any other metrics that you do today, our gross NPAs are less than 1.2%, and I think that's after COVID, and I think that's a function of tech and having a high touch point engagement through our material platform with all our lenders. And the one thing that tech does not do, we fundamentally believe that lending is a collections business. We fundamentally believe that it's easy to give money, but it's tougher to collect money. And hence, we understand that that layer can be supported by tech. But unless you build a large collections engine yourself and you have the appetite to collect from a customer, whatever lending you do, you can never get your money back. So I think two benefits of tech, but then fundamentally realize that you're giving money and you need to collect back. If you do all this right, you can ensure you have high touch point with the customers, and I think that's the secret of keeping our portfolio in check, even when something like COVID happened for us.
No, perfect. I think Vasant, you bring a very good point that the whole financing approach has been historical information. In the loose word, we say post-mortem in internally, right? But I think what data and technology enables you to keep a completely dynamic, real-time behavior check. And there is so much of data available today, which you can bracket it under alternate data, right? So, I mean, just for argument's sake, if you jump a traffic signal, that data is possible. and then that kind of know your behavior. So perfect, Vasant, you bring a very important. Let me go to Anil now. Anil, my question to you, it's actually not a question, it's actually an urge to deep dive into the whole FPO and the farmer part. I know FPO is a very, very critical layer or framework to reach to the bottom. Would you maybe spend a couple of minutes to explain to the benefit of audience how does that work and what are you doing?
Okay. So the farmer producer organization is actually a farmer collective, Prakash. There are 3-4 legal forms that constitute what a FPO space is. Farmer producer company is one dimension. Mutual benefit trusts, new age cooperatives, and the credit cooperatives. You can have multiple legal forms, but all of them come under the farmer collectivization as a bucket. We started our journey in 2014, setting up branches and looking at working with individual aggregators who brought in two kinds of capitals that we were looking at leveraging. One is the soft information about the credibility of the person in the vicinity, which is social capital. The second one is the transaction history, which is the trade capital. In other words, if I take a individual milk aggregator in a village who is collecting milk from, say, about 200 people, he would have two sets of information, not documented through documents. I will come to your postmortem dimension very soon. Not documented, but the information exists in the form of, hey, I know this family for the last 15 years and they have been pouring milk to the extent of, say, 10 liters per day, and hence my payout to them is about 250 rupees per day. Now, whom to lend is a social capital. How much to lend is the trade capital, right, which is the transaction history. That's how we built our entire underwriting, which was where the geographical dimension of agriculture came in, because this is the practice that we saw in Tamil Nadu, where you can work with individual aggregators and they have multiple individual farmers pouring milk. The moment we looked at, beyond Tamil Nadu, where we looked at Gujarat and Madhya Pradesh and things like that, we started, even Karnataka for that matter, we started realizing that this individual aggregator actually is replaced by societies, Doodh Utpadak Sangh, where the role of the aggregator is still being played by the society, excepting that now the society is run by a set of people, either office bearers or the board of directors, as they are called, or some of the progressive members of their own community, again doing two things. One, engaging with a set of people over a period of time in doing the transaction that they do on a daily basis. Social capital and trade capital that are available. So we pivoted our model in 2016, that rather than working with an organic structure of opening branches and working with individual aggregators, why don't we look at a B2B2C dimension in which the middle B becomes the farmer producer organization, and how do we then work with the FPO, the middle B, to reach out to their members. That's the entire approach that led us to hone or harness this social capital, trade capital dimension. And then we started looking at how do we engage with the FPOs in reaching out to them. Now, the moment we started looking at FPO as the vehicle for us, we came out, or we structured with a framework that we refer to as AMLA framework: aggregation, market linkage, and advisory services. Aggregation, a set of people doing the same economic activity coming together, whether it is producing maize or whether it is dairy as a value chain. These are the people who are doing the same economic activity, and because they are in the same economic activity, their requirements are similar, whether whatever they want to buy as inputs or where they would like to sell, and the dynamics of where they sell, they are all similar. And when they come together, why do they come together? They come together for a collective benefit, and that collective benefit is, if whatever they are buying, whether it is seeds or animal feed or fodder or inputs or urea, what have you, can they buy in bulk cheaper? And when they are selling, can they sell with a little bit of aggregation and primary processing, so that the delta of what they buy becomes cheaper and what they sell becomes better than what they would sell with the foreign particles and in a smaller quantities, and hence there is a collective benefit. which is what the ML of AMLA framework represents, Prakash, the market linkages. The moment you touch the dimension of market linkages, then all that Vasant mentioned in terms of working capital becoming, a key constraint manifests in agriculture as well. Because as an individual farmer, I am going to the local retail shop, and that local retail input shop knows me, at times gives me credit. But the moment the aggregated demand becomes 500 offers, the retail shop, one, may not have the ability to cater to a working capital structure for 500 people in one go, because that retailer is also a small guy. He also has working capital constraints. And the moment you go up the ladder in terms of value chains, there is no social capital, because they have never known each other, and there is no trade capital because there was no transaction history. So how do we build this social capital, trade capital that intrinsically exists in a collective with a market linkage structure is where our lending becomes relevant. Our lending becomes relevant only to replace social capital and trade capital with cash on table in relation to the FPO's engagement with further chains in the value chain or further levels in the value chain. When these two are looked at is when advisory services become relevant, where how do we produce what the entity is looking at. For example, again, I go back to Vasant because I resonate a lot with what he's saying. He is from ITC. No, ITC doesn't procure every grain of wheat that is produced. ITC has some quality standards, some geographical specifications. Sarbati, atta is an important dimension. So where is the Sarbati wheat produced? It is produced in the hinterland of, Madhya Pradesh or, up north. How do we make sure that this kind of quality, specs are brought into the FPO so that the biggest, vulnerability and danger of the FPO is where they have aggregated and they don't have a buyer? How can we bring in the advisory services so that they know what an ITC looks for before even anticipating that ITC would be my buyer, or what a Ruchi Soya would look at, what a Adani Wilmar, what a Britannia looks for, what a Godrej Agrovet looks for in terms of moisture and aflatoxins in the maize for their animal feed procurement. So can we build that capability of understanding how do they, one, produce and take care of their aggregated procurement from the dimension of what the market is looking at. And that is what Samunnati would be looking at doing. And on the dimension of technology, it's extremely important that technology for us is more to bring our efficiencies and our ability to scale rather than making our FPO and farmers become technologically savvy and capable. That is a little long way. Can we use technology to bring in efficiencies in our scale of operations is what we'll be looking at, Prakash.
Perfect, Anil. Very, very big thank you to you for deep diving into it. And as I said in the beginning, I would love to have a discussion about this topic for many, many panels. And I would, and there is so much of work happening. In fact, we have run out of time. We have few questions which we'll see if we can answer separately. Before I hand it back to Pooja, I would just say one thing which comes to my mind is that there should be a lot more discussion on this topic with people like you, because as Rushi said, I think Vasanti also said, Anil also said, there's a piece of work which is happening in this will go on for years, and more people have to get used to it, participate in it, adopt it, change their mindset, and then only it will be successful. Let's say Rushi said that half of our the MSME lending, if it's X, there is another X waiting to be lent, or maybe part of that X is under lent today. So it was a very interesting discussion. Unfortunately, we just had 45 minutes, but thank you, Anil, thank you, Rushi, and thank you, Vasant. A big thank you to you guys to share. I'm sure audience would have learned a lot. I have learned a lot, and we should have more discussions on this, and all the best for your business. And thank you for your time. Back to you, Pooja.
Thank you so much. As you rightly mentioned, this can take hours and hours, and the conversation was so interesting and it was so informative that these kind of discussions gives a lot of idea to a large mass who's involved in such kind of businesses. So thank you so much for all the information shared. And of course, next time we will ensure that we give more time. But for now, thank you very much for your support and your participation. Thank you.
Thank you.
Thank you.
Thanks for having
Thank
us.
you, Vasant. Thank you, Rishi. Thank you, Anil.
Thank you, everyone.
Bye-bye. Take care.
Thank you, Prakash. Thanks.
So this was a very powerful session. All the speakers were so amazing. Their experiences were so amazing. So much of good discussion that happened. But like we said, time was not on our side. But anyways, thank you so much, each one of you, for joining the Global Fintech Fest.